Hi, thank you for listening to Rivers Investment Channel. I'm Chi Yao. Today, we will have our third episode for Investment or Speculation series. Today's topic is the real estate market. The real estate is an input for all productive resources. People live on it, factories produce on it, and business prosper on it. The real estate price is always derived on the productivity or cash stream. But now, since money turns into currency and interest rates are fixed by central banks, the real estate market deviates from the original purpose, a vital input for productivity. Suppressed interest rates and currency printings combined with affordable acts, the loose turns have enabled the entire society to speculate with longer terms, lower rates, and less down payments. After decades of government-created environment, real estate market has transformed into the ultimate speculation vehicle. As long as the return is slightly higher than holding costs for real estate, the price will go up. At first, people feel good because the price goes up, but it is all delusional. On the productivity side, since the real estate market has become so expensive, new business found it too costly to enter, and existing business sells the real estate for profits it will never be able to make. The real estate market turns into price difference cashing machine rather than an input for productive resources. The society starts to lose wealth. The real estate market becomes a paper people buy and sell, but no wealth is produced. Manufacturers are struggling because they cannot catch up with the growth in fiat currency, which speculators bring money out of thin air and still can share the wealth created by hard works. On the demand side, after this long period of low interest rates, money printing, and loose terms not only invite speculators but also supply buyers into the real estate market. Once the economic condition turns south or the interest rate goes up, price pressure will build up as speculators rush to sell and supply lenders cannot afford the payments. A much bigger housing bubble will pop. A low interest rate environment must continue for the market to stay afloat. However, if unsupported with the further price appreciation for merely 3 years, or the cost of speculation exceeds the return for selling houses, speculators will not be able to afford mortgage payments. People are fooled into too concerned about the low interest rates and neglect the real estate price may go down. If the market starts to drop, speculative demand will turn into supply. A drop in the real estate will make the real buyer more reasonable, and early repayments will be more meaningful. On the supply side, when governments create such a phony demand, the supply will increase for profits. As the time goes by, eventually, supply will always meet demand, no matter how much air governments and speculators blow into the system. More and more real estate property will be vacant. The pressure is always building up in the process, waiting for coming brought back. With estimated 20 million houses either vacant, underwater, or delinquent in the US in 2013, and more than 100 million in China in 2010. Think about how many properties or empty towns are built since then that store energy is destined to release all in once. On the market side, mortgage liabilities of buyers are also mortgage assets of financial institutions and naive investors. When the value of a house is much, much lower than its price, it's hard to imagine anyone will keep paying the mortgage when the new house is priced lower. A big write-off will come back again soon. But this time, the pressure is much higher as more houses are built after the Great Recession. All price differences between the value of the mortgage and the current price will be the loss for the market. The problem either resides on the lenders or the borrowers. To wrap it up, if a market is not supported by the free market, the market is a bubble. The difference between the value and the price shouldn't be counted as assets. Speculators and governments won't face the reality, but we have to. Thank you for listening to Rivers Investment Channel. This is Chi Yao, signing out for now.